All right. Folks, you might have noticed that natural gas prices are skyrocketing higher. And no, we're not just talking about European natural gas prices, we're talking about American ones too. And in this video, we will go over the reasons behind the surge in natural gas prices. And it is a fascinating story that involves a mystery trader with a massive bet. But let's go back to the bases. I produced a video not so long ago talking about the momentum in natural gas, and this video is a continuation of that video. Now, one thing that is obvious behind the push in natural gas prices higher is something you might have heard about we call inflation. And inflation has always been a monetary phenomenon, meaning when the Federal Reserve, the central bank of the world, prints endless liquidity, trillions and trillions of dollars worth of money, fake money I should add, to prop up the equities and real estate markets to so-called stimulate the economy. Well, they overstimulated the economy, and now we have a problem called inflation because the money supply has increased rapidly in a short amount of time. And in inflation, every time you see a dip in commodities, it is a dip to buy, absent of one thing, an action from the Federal Reserve to tackle inflation, be it by increasing interest rates rapidly and aggressively, or other measures that will take down inflation seriously. So every time you see a dip in oil or natural gas or lumber or grains, you must ask an important question. Is the drop that we got in grains, oil, gas, whatever commodity it is, was due to a response by the Federal Reserve to combat inflation or not? And if it is not, then it is a dip to buy. And this is exactly what we said about natural gas before the year even started. Back in December, a lot of geniuses been talking about peak inflation and inflation being transitory. Look at the evidence. Oil is down, natural gas prices are down, inflation is peaking, and it's about to go away in 2022. In this channel, we said that this is all horseshit. Inflation is not going away without rapid and aggressive action by the Fed. And in this channel, we have forecasted the comeback of natural gas back in December of 2021. Take a look. Look at natural gas prices. Yes, they went down, but they're still up 150% since their bottom back in 2020. And my prediction is natural gas prices will curl back higher again, just like we saw with lumber. Again, this is the nature of inflation. There is no such thing as a transitory inflation. And here's the update. Since then, natural gas prices spiked up higher by over 80%. Yep, 80%. But the majority of the gains came from month-to-date performance. As you can see, the April performance so far, natural gas is the leader in commodities, scoring about 30% gains this month so far. So what was behind the insane rally in natural gas futures? I mean, we're talking about a spike of 8% alone in a single day. And we're seeing these spikes repeated. We're seeing natural gas as of late gaining 6%, 8%, 9% in a single session. So what's going on here? We can talk about inflation all we want, and we will talk about the situation in Europe between Russia and Ukraine and the scarcity of supply. But there is also a technical, or shall we say a mechanical reason behind the massive move in natural gas prices. And that is what we call a short squeeze. And the short squeeze, in a nutshell, happens when somebody or a certain entity buys an insane amount of call options out of the money, betting that a certain commodity or a certain equity or a certain security, whatever it is, will pop higher, significantly so from the current prices, in this case, natural gas. When that happens, a lot of traders who are short, a lot of market makers who are short the commodity, in this case, natural gas, they start to think, why is this entity or this trader or whoever they are, why are they seeing natural gas prices jumping significantly higher in the near future? Most importantly, why are they bidding an insane amount of money for that occurrence to happen? They probably know something. They're probably insiders. They probably have information that we don't have access to. And as a response, what happens is these shorts start to cover their short positions by buying the underlying asset, in this case, natural gas. And as a result, the prices of this asset, in this case natural gas, moves higher, and hence the short squeeze. And here is the trade behind the recent short squeeze in natural gas. The headline from Bloomberg reads, trader makes lottery ticket bet on U.S. natural gas doubling to $10. And by the way, this was back in April 1st. So this trade is already more than profitable. We're talking about over 1,000% gains. But here are the details. The trader bought an unusually big chunk of 31,382 options contracts on Thursday that would give them the right to buy gas at $10 per million BTUs by the end of July. As a part of the trade, it sold similar-sized package of the 10.5 calls that will expire on the same day, according to block trade data complied by Bloomberg. In other words, this trader bought an insane amount of the $10 calls with the expiration date of July. They also sold the 10.5 calls with the same expiration date, so they're limiting their profit to 50 cents, assuming they will hold the trade all the way till July. The transaction cost less than 2 cents per MMBTU of gas, which corresponds to the price difference between the $10 calls and the 10.5 calls, and totaled more than $5 million. In other words, this trader is looking to flip 2 cents into 50 cents by the July expiration. This is a massive gain to be made. Now, the question is, why not just buy naked calls? If it is a lottery ticket kind of bet, why not just buy the $10 calls and leave it at that? In my opinion, this is a move done as a hedge, as an insurance policy, in case the trader is wrong. They're limiting their entry price. But regardless, the trader doesn't have to wait till July's expiration to close this trade altogether. The recent move alone, we're talking about 30% gains in natural gas prices, U.S. natural gas prices, the Henry Hub futures. That's enough to make this trade extremely profitable as it is right now. Yet we're not sure what this trader wants to do. Do they want to hold all the way till July? Do they see an explosion in natural gas prices by then, perhaps? Or are they going to book profits right now? Anyhow, continuing. The trader would benefit most from a rally to $10.5 before the option expire on July 26, allowing it to make 50 cents per MMBTU, or more than $150 million, minus the premium paid for doing the trade. And remember, they paid $5 million. They're looking to make that into $150 million. Natural gas futures surged more than 50% in the first quarter, a record for the period, due to concerns about tight inventories for the heating and power plant fuel amid booming export demand. Still, a surge to $10 by summer is seen as unlikely. The commodity traded in New York at about $5.70 on Friday and should average $3.70 in the third quarter, according to analyst forecasts compiled by Bloomberg. Well, these analysts should pull their heads out of their asses because we're already over $7 in natural gas. So it appears that this trader knows something that these geniuses, these strategists, don't know anything about. And as you can see, here's the daily chart of natural gas futures. Unbelievable rally. We're already over $7 now. The problem is, it is getting a little overextended, technically speaking, on the daily chart. Meaning, if this trader decides to bail out and book profits right away, we will see a sharp pullback in natural gas. But here's the problem. We look at a weekly chart, for example. It is not overextended. It is not overbought, quote unquote, and it has more room to rally. It could go all the way to 8, perhaps 9. When we switch to the monthly chart, as you can see, yes, we're getting to the same range on the hour side where we have seen sharp pullbacks in natural gas before. But it still has room to rally. It has a lot of room before it becomes, quote unquote, overbought or overextended. We know from a technical perspective that things could be overbought and overextended for a long period of time. So who's to say that we're not going to see a massive surge higher, just like we've seen back in the inflation period of 07 to 09, where natural gas rocketed higher? Who's to say that we're not going to see the same phenomenon, and natural gas futures will indeed trade above $10 by this summer? It is entirely possible. It is within the realm of possibility. We're not saying it is the consensus case, but we're saying it is possible. And of course, one of the solid tailwinds behind natural gas prices to move higher is what's going on in Europe, the conflict between Russia and Ukraine. So far, we have not seen a massive surge in U.S. natural gas prices because we produce those domestically. And so far, the winter season hasn't been really that bad at all. Yet the picture is entirely different over in Europe. because natural gas prices over there are spiking significantly higher. The majority of the European natural gas supplies come out of Russia. Now, we have a lot of sanctions imposed against Russia by Western countries, including European countries. Yet these sanctions are not touching Russian oil and gas yet. Keyword yet. But the damage is already done because the speculation, in the futures market at least, pushed natural gas prices higher on the possibility that we could see at some point sanctions and perhaps a flat-out ban of oil and gas imports out of Russia. Furthermore, we could see Russia cutting supplies to European countries, perhaps in retaliation to the sanctions on other products. We also know that the Russians are demanding European countries to pay for natural gas in rubles because Russia's foreign reserves are frozen right now. Of course, the European Union, European countries that import a lot of gas from Russia are now scrambling for options. Do they pay Russia for natural gas in rubles? Well, that defies the other sanctions. It makes them pretty much useless. So we're seeing these European countries scrambling for options. One of the options is gas rationing, and we're seeing Germany doing that already, or at least thinking about it. Yet there are warnings that if European countries do any gas rationing, specifically Germany, we could see structural damage to the German economy. And hence, European countries are now looking for the US to secure and substitute Russian natural gas with liquid natural gas from the United States. And this is pushing U.S. natural gas prices higher because now we have new demand. It is not just the domestic supply that U.S. natural gas producers have to supply. Now they have to supply European demand as much as possible. In theory, we have a lot of natural gas in this country, but in reality, natural gas producers cannot supply a sudden surge of demand right away. It takes a lot of time. In the meantime, we have a situation where demand exceeds supply and therefore natural gas prices move higher. And as you can see, the United States have been increasingly in recent years exporting a lot of LNG, liquid natural gas, to other countries, including European countries. In this case, it was mostly Asian countries, but now we have to satisfy European demand too. And by the way, shipping natural gas, in this case liquid natural gas, on ships is not really environmentally friendly at all. So the irony here of not using Russian natural gas that is easily transported via pipelines in lieu of US natural gas, liquid natural gas that produces a lot of pollution in the transportation phase of the supply chain. But anyways, now we're seeing a lot of European countries meeting with liquid natural gas firms here in the United States to secure supplies. Delegations from Latvia, Estonia, diplomats from Bulgaria, Estonia, they already said Estonia, they're saying it again, France, Germany, Hungary, Latvia, and the United Kingdom toured the Golden Pass LNG export project at the Sabine Pass in Texas, and later met with shale gas producers in Houston. And listen to this. Group discussions included top executives from Chesapeake Energy, Coterra Energy, EOG Resources, and EQT Corp, he said. Individual meetings are planned between U.S. executives and Latvian, Estonian, and Slovak commercial representatives. But here's the problem, folks. Either way, the status quo that we have right now shows an imbalance, a severe imbalance between demand and supply. You take the LNG production and the under construction projects besides Russia, you combine that with the Russian production, on top of that, the Russian projects under construction, and all of that taken together is not enough to supply the demand in the post-Ukraine war scenario. For now, the supply-demand imbalance is manageable, shall we say, but you fast forward to 2023, 2025, and beyond, and you can see that the demand far exceeds the supply. In other words, the tailwinds for natural gas prices to continue to move higher are firmly intact. U.S. natural gas futures closed at the highest level in more than 13 years, reaching prices not seen since before the shale revolution unlocked the nation's vast reserves of the fuel. And by the way, here are different scenarios for Japan, China, and South Korea, one of the top exporters of U.S. liquid natural gas. If we have a hot summer, we might see Chinese demand moving a little higher, but we're not going to see any demand from Japan or South Korea moving higher. If we have a cool summer, we could see demand moving down in Japan, in China, in South Korea. But if we have a cold winter, we could see a massive surge in demand, specifically by Japan, but also China and South Korea. And lastly, if we have a warm winter, we could see a slight drop in demand, specifically from China and South Korea. So again, as futures traders, we always have our meteorologist's hats on when we talk about natural gas. But if we have a cold winter, this will only amplify the bullish case for natural gas. Because even if the war is over between Russia and Ukraine, the assumption is we're not going to see the removal of sanctions right away against Russia. And even if that happens, there is a change in attitude by European countries. They understand now the reliance on Russia for a long time was not a good strategy. And in either case, whether we have peace or not, they're going to have to secure energy resources from other places besides Russia. It's going to be more imports of liquid natural gas, in this case from the United States, and that enhances the bullish case for natural gas prices to continue to move higher. It also enhances the case for uranium prices to continue to move higher because they're now thinking about perhaps nuclear energy as an alternative. So, in this case, how do we benefit from the bullish case in natural gas? We talked about it in this channel numerous times, but here's a reminder. You can play the surge in natural gas prices by investing in fertilizers, because fertilizer stocks, historically speaking, have a positive correlation with natural gas. We talked about these names in details before. For example, when we talk about the agricultural stocks, I discussed with you fertilizer names, the likes of Mosaic, Nutrin, ICL. Look at the year-to-date gains in these names alone. Mosaic is up over 93.5%, Nutrin is up almost 49% year-to-date, and ICL is up over 31%. These are massive gains, folks. Everybody's talking about a bear market and the market's crashing, and it's not a good time to invest in stocks, but there is a bull market within the bear market, and the bull market is in energy, in fertilizers, in agricultural stocks, and many others. And in the past, in this channel, we also discussed the bullish case for natural gas producers. In this case, I gave you a list of names from Southwestern Energy, Chesapeake, Coterra, EQT, and many others. And you have many other natural gas producers, by the way, beside this list. You have a name like Cheniere, for example, the ticker LNG, and many others. But let's take a look at these names alone. Here are the year-to-date gains. Look at this. Southwestern Energy, gains of over 75%. Chesapeake, over 48%. Range Resources, over 81%. Coterra, over 57%. EQT, 94%. CNX, gains of over 63%. Devon, 42%. EOG Resources, gains of over 39%. Again, when you ask, where is the bull market? Here it is. It's right in front of you. The problem is the timing is important. These things become overbought, technically speaking, and they need to pull back. And then before you buy the dip, you must ask the question, are the tailwinds still intact? Number one. Number two, is the Fed doing anything different to combat inflation, or are they still way behind the curve? If they are, then you buy the dip, because in all likelihood, natural gas prices will continue to move higher, and these stocks will also continue to move higher. You can play the rise of natural gas in another way, by buying utility stocks. The case for utility stocks is not as strong as fertilizers. Fertilizers is the strongest case because you have a cherry on top. It's not just that natural gas prices are moving higher. It is also fertilizer prices moving higher. Why? Because Russia happens to be one of the major producers of fertilizers, and now we have sanctions. Nothing can move out of Russia. And the case for natural gas producers here in the United States is also strong because the demand exceeds the supply, and they will enjoy higher prices for a long time. The case for utility stocks is a little weaker, but it is working for now because they have to buy the natural gas supplies at the market price, and the assumption is they will pass those extra costs for buying the natural gas down to you and I, the end consumer, and they will make a profit off that. And in this case, we have certain utility stocks that are more exposed to natural gas than others. We have names like NI Source, Exelon, Centerpoint Energy, Atmos Energy, New Fortress Energy. All of these names have been benefiting tremendously from the rise in natural gas prices, at least for now. Look at the year-to-date gains, for example. 15% for NI Source, 19% for Exelon, over 16% for Centerpoint Energy, over 14% for Atmos Energy, and a stunning gain of over 84% year to date for New Fortress Energy. Now let's look at the charts of these names one by one and see if we can spot certain opportunities from a technical standpoint alone. We will look at NI Source, for example. We have a bullish trend that is getting a little steeper. Could we see a pullback all the way down to the trend line? That is possible if natural gas prices, for example, collapse. But the assumption for now is, look at the RSI. It got way overextended, it got overbought, quote unquote, and now it is pulling back, cooling down these overextensions on the momentum indicators. The question is it going to be a massive pullback all the way to the trend line, or a small pullback, a mini pullback to get rid of the excesses for now, and then we see another leg higher? Your job as a trader, looking at this chart, is waiting for that reversal. For now, we are amidst the pullback. And if we get a solid reversal before the trend line, and it appears that we're seeing a lot of demand, for example, a surge in buying volume, then you have a confirmation that we got a reversal and we will see higher highs in this chart. Another one. What about Exelon? Here's the chart for the ticker EXC. This is a daily chart, by the way. Again, it got really overextended on the RSI and the MACD indicators. Very strong momentum, and it is highly diverted from the trend line. The assumption is at some point it's going to go down to meet that trend line one way or the other. Either in a bullish scenario to wait and consolidate and perhaps move higher on a slower pace and allow that trend line to catch up with the movement of the stock, or it's going to pull back sharply to meet the trend line. For now, looking at all of the tailwinds for natural gas, the assumption is we could see a pullback perhaps all the way down to 48, 46, and then the rally will resume again if natural gas prices continue to move higher. But here's one problem with utility stocks. At some point in this inflation, we will see consumer purchasing power diminishing rapidly. At some point, those consumers will be behind on their utility bills, and these companies will not be able to pass that inflation down to the consumer anymore. And therefore, I say the case for utility stocks is a lot weaker than actual natural gas producers or even fertilizers. But in any case, here's another chart for Centerpoint Energy, the ticker CNP, a daily chart. Now, I would avoid buying that one because it did not experience the pullbacks that we've seen in the previous two charts, meaning this chart's going to pull back sooner or later. You don't want to buy it right now. You want to wait for the pullback, see how far the pullback is going to get us, and then await a confirmation of a reversal and a final check on natural gas prices. If they're still higher, then you buy the stock. And here's my favorite name in this list, Atmos Energy. And the reason is it is a pure natural gas player in utilities. And the ticker in this case is ATO. We're looking at a weekly chart, by the way. As you can see, this chart made a bottoming double bottom formation. And since then, it has been a rocket ship higher. The problem in this case is it is facing a stiff resistance at around 121, which is the previous high before the crash in 2020. It's going to face tough time at 121. And look at the momentum indicators, by the way. They're overextended. They're begging for a pullback. Now, in a bullish chart, we see the RSI and the MACD, the momentum indicator, is cooling down as the chart consolidates to build that energy to move higher again. So if we see consolidation at around 121, a little below 121, working out these overextended conditions on the RSI and the MACD indicators, then this is bullish behavior, not bearish. And sooner or later, the chart, after washing out all of that excess on the RSI, for example, it would gather a lot of energy in the meantime to unleash another leg higher. And lastly, what about New Fortress Energy? The ticker in this case is NFE. This is a daily chart. As you can see, the chart has been on a downward trend for a long time. A sloping line of resistance that has been broken to the upside and rechecked for support back in February. And since then, the chart has been exploding higher, and it stopped at around 48, 49, and it pulled back dramatically in a gap down manner. Now it's working its way higher to close the gap at around 45, and in doing so, it managed to work out all of these overextended conditions on the RSI and the MACD indicators. So as a trader, you want to see how the chart behaves at around 45. Is it going to close the gap and then take another leg to the downside? That would be bearish, not bullish. But if it closes the gap and it continues to move higher, that is bullish behavior, not bearish. Now, when we switch to a weekly chart, for example, for the same ticker, NFE, look at this. We're not seeing overextension in the RSI or the MACD indicators. Matter of fact, they're just moving higher after a long period of declines. All of that energy is being released to the upside, and I believe that we have more gains to come in this chart, and it will probably move its way higher all the way to the last resistance at around 55, and then it will become really overextended. It will face stiff resistance at around 55. Anyhow, folks, this is the story behind the rise in U.S. natural gas prices. Multiple tailwinds, from inflation and the reckless Fed policy to the conflict in Europe forcing customers to switch from buying Russian natural gas to U.S. LNG, and lastly, the short squeeze that we're seeing as of late from the mystery trader betting that we will see natural gas prices doubling to over $10 by this July. And with that, folks, this is all I got for you for this video. But stick around and stay tuned, as I have more videos coming for you over the weekend. Take care.